Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Hello everyone, welcome to Aurora Energy Unplugged. My name is Mateusz Wronski and I am the Global Software Solutions Director here at Aurora. I'll be hosting today's show and I am joined by Ralph Johnson, who is the Head of UK Business Development for Habitat Energy, who are one of the leading battery storage optimizers in the UK and globally. Ralph joined us at the Aurora Battery Conference in London a couple of months ago as a panelist on our panel devoted to software in storage, and we thought that we only managed to scratch the surface in that conversation. So we've decided to continue and deepen the dialogue to hear more insights from Ralph in our podcast. Ralph, a very warm welcome to the show, and thanks a lot for joining us.
Thanks very much, Mateusz. Great to be here. Really looking forward to the conversation today.
Brilliant. Well, maybe we can start with you telling us a little bit about yourself. So both about your current role and what it entails within Habitat, but also about your background and what's led you here.
Sure, happy to do so. So as you mentioned, I'm Habitat Energy's UK Head of Business Development, a role that I've been in for 3 years now. In that role, I'm responsible for originating and managing the strategic partnerships at Habitat, for identifying and assessing key opportunities for optimization, both with battery energy storage, but also new technologies, and really exploring new products to improve the value offering that we have for clients as an optimiser. In terms of my background, I've been in the UK industry, and it's quite strange to say this, for 17 years now. I joined back in May 2007 in a role in EDF Energy, looking at pricing of supply contracts. And since then, I've really had a range of different roles across different companies, working on pricing risk, looking at finance, modelling for projects. My big jump across to the renewable world was into origination of PPAs and looking at structuring PPAs for wind and solar. But since then, I've worked at a number of companies focused on different ways of trading power and also looking at frequency and the measurement of frequency. So all of that really naturally transitioned to the battery storage industry, where we're now looking at not just standalone batteries at Habitat, but also co-locating those batteries with renewables and how those batteries will support the growth of the renewable industry in the UK.
17 years. Well, I'm at 10 and it already feels weird and pretty long. So well done. It sounds like there's a path leading you where you are through PPAs, through renewables, through frequency, Habitat. So could you tell us more about Habitat, your portfolio, the assets you optimize, what markets you play in, and which jurisdictions?
Sure, happy to do so. So as you mentioned, Mateusz, we're a specialist provider of optimization services for standalone and co-located renewables and energy storage. As I said, we're a service provider, so we don't own assets. We actually manage our clients' assets to maximize revenue, but not just maximize revenue, maximize lifetime value for those assets. Humble brag at this stage, we were awarded Trading and Optimization Team of the Year at the inaugural Energy Storage Awards last year, something we're very proud of. When I think about Habitat and our founding, we were really founded with the view of focusing purely on energy storage. And that's really important in terms of our approach. We have developed all of our tools in-house. We're focused on utilizing machine learning and algorithmic dispatch to manage the batteries under our control and the renewable assets under our management, ingesting state of health data from those assets, generating forecasts for the various markets that we could trade those assets in, and utilizing a cloud-based dispatch platform that ingests that data and presents a dispatch profile for the asset. But all of that is overseen by our trading team, and that's really important to the Habitat approach. It's a hybridized approach, which we think gives the best value. The other key thing about these assets are they're incredibly valuable, and protecting them and overseeing them and monitoring them for your clients is a key part of what Habitat does. In terms of our portfolio, we now have 500 megawatts worldwide operational under our management, with an additional 500 megawatts currently contracted and likely to be operational within the next 12 months. It's a pretty seismic shift from where we were 12 months ago, when the number was probably a quarter of that. And I think that's a function of Habitat's success in this space, but also a function of the just build out of storage across the world, and the realization of the value of that and the necessity of storage in this space. Our portfolio consists mainly of lithium-ion batteries. And it's interesting how the duration in the UK especially has changed since I've been at Habitat over the 3 years. When I joined, we were really optimizing a portfolio of about 1 hour on average in terms of duration. But now that duration has really increased to 1.5 up to 2 hours and beyond now. And that's, once again, a really interesting transition we're seeing in the market.
Mm-hmm. And Ralph, 1 gigawatt, that's quite an achievement and a great round number in terms of your braggawatts. Could you tell me a little bit more about how it's distributed globally? So is it mostly in the UK? Is it part of it in the US?
Great question. Yes. Yeah. So the UK was our core market back in 2017 when Habitat was founded. But now we have market access and teams based in both the US, in Texas, so the ERCOT market, and also in Australia. Those markets and our growth into those markets has really been supported by our acquisition by Quinbrook Infrastructure Partners back in 2021. Our parent company now, who has also the same vision as we do, that those are really important markets for storage and key areas to focus in. As I said, the UK was our core market. We started there first, so we have more volume in that market currently. So closer to about 400 megawatts in the UK operational. However, in the US, we've taken our first assets live. So we now have 60 megawatts of live assets in the US. And in Australia, we've now got about 30 megawatts. But what's really interesting about those Australian assets is they're co-located. So big difference we see between those markets is more co-location in the Australian market, and looking at those hybridized solar and storage or wind and storage projects, really, really exciting in that space, and something I'm sure we'll take lessons from and take into the UK market.
Great stuff. We'll come back in a second to how you compare these markets, because that's a topic in itself that's super interesting, and you bring a pretty unique perspective. But before that, I just wanted to dig a little bit deeper into what it means to be a good optimizer. And part of the question is, there's a lot of battery optimizers out there. I think by one count, I've seen a number of 25 in the UK alone, which for a market that has only a few gigawatts of batteries sounds maybe a little bit excessive. But all of them have slightly different approaches. Obviously, the goal is to maximize your client's revenue. But how do you go about it? How do you differentiate yourself strategy-wise? You hinted on some of these things that matter to you, but could you tell us a bit more?
Yeah, sure. I'll take you one better. In fact, I think at my last count, there was 36 parties offering optimization services in the UK. So a very, very busy marketplace here, and probably a sign of the level of maturity of the UK space, especially. As a relatively simple answer to how you differentiate yourself, it's the key one that's very important to clients, which is performance. So getting the best results for clients' assets. As you very kindly pointed out at the top of the show, Habitat is considered one of, if not the best optimizer in the UK space, and is becoming more recognized in the US and Australia. We have had top performing asset in the UK, according to publicly available data at least, which is a point we'll come to shortly, I'm sure. It's since September 2020. And our portfolio consistently is seen to be in the top quartile of assets in the UK. And I think consistency is another really important point there. You can have a top performing asset for a couple of months, but if that asset falls down the pecking order, that's not a sign of good performance. It's a sign of a couple of good months. You really need to have your assets at the top of that. We'll call it a leaderboard, but top performing quartile consistently throughout their lifetime and throughout the time you're optimizing them. Mm-hmm. What I will say to your point is, in terms of making value for clients, it's not just about maximizing that short-term economic value. It's about maximizing lifetime value for the projects as well. And when we consider that lifetime value, we're not just talking about having long contracts with your assets, which is a key part in terms of building long-term partnerships with clients. But it's really about thinking about how asset lifetime will change with the actions you take and managing things like degradation of battery storage. Batteries are relatively unique as an asset class, and how you treat them and how you run them will impact their lifetime. And that's something we're really focused on at Habitat, that I believe really differentiates us, that we observe how the planned physical dispatch of the asset will affect its degradation. So, and that degradation can be impacted by a number of different physical criteria. It can be the temperature of the asset when you're running it. It can be the depth of discharge that you're planning to take in the market, how quickly you're cycling that asset, and how regularly, how long you're holding specific state of charge for. All of this needs to be factored into your optimization decisions to essentially produce what we think of as a hurdle rate. So how much you degrade the asset by will bring forward its end of life as such. And you know roughly how much it will cost to replace that. So you can apply a hurdle rate based on your expected replacement cost. So looking at that hurdle rate and then assessing it against the market opportunity or the trades you're planning to make is fundamental to maximizing lifetime value. And that, we believe, is a really unique approach that Habitat adopts. Secondly, and I've touched on this a little bit, we are specialists in this market and storage experts. Everything we've built is from the ground up. Everything we've built has been with the optimization of storage in mind, with the option of doing that in multiple jurisdictions, as we mentioned. We haven't really built our platform on the back of existing infrastructure and trading systems. We haven't built it or built our teams who may have been historically used to operating thermal assets. Everyone who's brought in is focused purely on battery storage. And we think that's incredibly important to getting the best results. Being experts in this field, understanding how batteries should be traded, how they react technically, how to integrate with them, once again, is fundamental to getting the best results. And beyond that, also, it's the partnership approach that we structure. We're a relatively small independent company compared to some of the other players in our market. And our business model is really predicated around building long-term strategic partnerships and not operating a transactional business model. Every battery we've got in our portfolio is different, and every client we've got in our portfolio tends to have a different approach or risk appetite. So we really tailor our approach to that, and we want to provide not just optimization services for the battery when it's operational, but also really support our clients throughout the lifetime journey of those assets. So supporting through development, helping identify commercial implications of certain design choices, helping clients make sure they get the right warranties for their batteries, because warranties are incredibly important and have a huge impact on how you trade that battery going forward and the revenue you can earn with it. Supporting through the commissioning and testing phase, ensuring assets can enter all of the markets that they need to maximize value in this space. We found, from our point of view, getting the best results for our clients and getting the best assets built ultimately benefits Habitat, but also benefits the energy system in the UK.
I wanted to get slightly deeper under one of the answers you
Sure.
made. So you hear a lot about, battery operation isn't about just, maximizing this trade in front of you, of course, because of the degradation, because of the lifetime value of the asset. And you mentioned how important that holistic approaches for Habitat. But what makes that difficult? Are you better at data collection than others? Are you better at measuring the asset? Like, everyone is aware of degradation, everyone's aware of warranties, etc. Like, what makes you excel in that field?
It's a really good question, Mateusz. I think, yes, you're right. Handling data is incredibly important. You're taking second by second data from your asset across a number of state of health variables. That's an enormous amount of data that needs to be handled, analyzed, and essentially ingested by your systems and then run through the various algorithms you have. So that is a serious skill and something that we excel at as a business. We have our own data science teams, we have our own technology teams internally, which allow us to purpose build tools that focus on that ingestion, cleaning, and recalibrating based on that data. And that's another key piece. It's about taking that data and learning from it and seeing the trends and then building your optimization logic and rebuilding and retraining your algorithms and your machine learning forecast based on that data. So that is certainly an area that being a specialist allows us to excel in. The other piece is we have got an incredibly talented trading team who understand that there will be times in the market where the value may not be there, or there may be higher value later in the horizon. And you need to understand when to reserve things like your cycling limit on your battery, or you need to have a strong view or a strong strategy as to how you're going to maximize value throughout not just a 24-hour window or 48-hour window, 6 months ahead, 12 months ahead. You need to be thinking strategically across a much larger window. And we think that's also incredibly important to getting lifetime value. It's not just simple algorithmic dispatch where you let a battery run and it looks on a day ahead basis at the opportunity. You really need to be thinking about how best to maximize the value in very varying market conditions. And we're seeing that already in the market currently. We've had a relatively flat period of volatility and opportunity in the markets. As the market moves to more merchant trading, we'll see more seasonality in the value, where the value is generated in this market. So making sure you're reserving your cycles, your trading opportunities, your capabilities for those key moments. And it's prevalent in the UK, but Texas, it's even more prevalent in that market. In Texas, we've certainly historically seen, periods of relatively consistent, good value, but ultimately you need to be ready to capture that huge value that occurs in those very tight windows. And it's an element of readiness as well, and constantly scanning the market, constantly being aware of changing market conditions that I think allows us to be the successful optimizer we are. And I guess that probably touches on the last point I'd make about what differentiates us. It's that nimbleness and adaptability in changing market conditions. Having our own teams, everything in-house, means that we're consistently adapting our approach, we're consistently building new tools, and we're consistently making sure that we can enter any new markets that materialize. The UK energy space has been volatile and changing highly over the last 24 to 36 months, new services coming in, new ways of procuring those services, new ways of trading ancillary services and wholesale market opportunities. You need to be nimble to make sure you can enter those markets from day one and not leave any value on the table.
And you mentioned one point here that I find particularly interesting, which is what you in-house versus what you buy. I think some of your competitors end up procuring third-party software for optimization. You build these things in-house. Is it mostly about that nimbleness that allows? Like, what kind of drove that decision? And what advantage does it give you?
Yeah, you're absolutely right. So the nimbleness is key. Being able to dictate what your strategic direction is going to be yourself is incredibly important. Having complete control of your own resources and where they're deployed, we think is an absolute necessity to getting the best results. I would also say being in control of your own IP and data is very important as well from our point of view, especially as a tech company whose intellectual property is our approach, our algorithms. We find having everything in-house allows us to maintain better control over that. That's not to say that I appreciate lots of other companies won't have the capital or the will to build out their own data science teams and their own tech teams and software development teams, or to spend the time developing their own tools. So third parties can be a good solution to that. I think you just have to be mindful in that situation that those third parties need to be ahead of the curve, or at least on top of all market developments at all time. You have to be certain that they're going to always prioritize you and meet the SLAs and the KPIs that you need to be a top performing optimizer in this space. And we've certainly found relying on ourselves and our own teams to manage that is our preference in terms of managing our operational risk than outsourcing that, I should say, to third parties.
That was a very diplomatic answer. If you can find someone who will prioritize you as much as you would prioritize yourself, then you can win with the third-party software. But Ralph, I wanted to ask you also about the algorithms. So you mentioned that a lot of the secret sauce is within how you handle data, with how you train the algorithms. Is there something that you can point to specifically where you guys are particularly proud of? Like, is it the way you forecast, I don't know, wind, or is it the way that you just can forecast multiple markets at once? Or is it just a combo of, like you said, specialists, battery specialists, and it's hard to point to any secret sauce, at least one that you could discuss in a radio show?
Yes, I'll have to be cautious here, Mateusz. That's a good point. I think in terms of what we're really proud of, certainly our wholesale market forecasting capabilities. We don't just have forecasts that are probabilistic and look at both the imbalance market and the system price, and look at the day ahead market as well and the balancing mechanism. So looking, certainly in the UK, I should say, this is where my focus is. So looking across all of those available trading markets, Being able to forecast that accurately is incredibly important to making your optimization decisions, partly because even if you're not trading in the wholesale market, you should be bidding into your ancillary services at the opportunity cost of not being in the wholesale market. And that's, once again, really important to make sure you get your bidding strategy and get maximum value for your clients. So what I will say is the accuracy of our forecast is incredibly impressive, and the number of different data sources they ingest to provide that quality of data is pretty mind-blowing. I think we're taking data from over 100 sources, taking hundreds and hundreds of data points per second across things like Elexon's BMRS reports, weather data, and looking at things like net imbalance forecasts from our own systems, but also we do tend to ingest some third-party forecasts. I will caveat it that not absolutely everything is in-house. You need other forecasts to validate your own as well. So taking that probabilistic forecast approach is certainly something we're incredibly proud of, but also the retraining of those models is something we're incredibly proud of. So going back and realizing where there's been changes in trends and updating those forecasts and continuously improving that is also how you stay on top of the game. And I think that is something where we really add or really show our unique capabilities as a business. I think the other piece is we don't just back all of our trading with probabilistic forecasts. We've also built fundamental forecasts in-house. And that's been a relatively recent development for us. We've become increasingly mindful of the trend in the market or the market's desire to find new products to trade batteries forwards. So being able to assess fair value for those products is incredibly important, but also just being able to assess the opportunity across the whole market over the next 5 years is incredibly important. So we've brought in-house capabilities to build our own fundamental market forecast over the next 5 years. And being able to overlay that with your probabilistic forecast, once again, gives you that additional confidence to make the right trading decision. So it's not just
Aurora, you don't have to convince us about the value of fundamental forecasts, and it's interesting how it becomes increasingly important for optimizers, and I suppose partly goes to that point of optimizing value over longer horizons, right?
Sadly, I don't have Aurora's length of horizon when it comes to forecasting.
That's why we can work together. We complement each other well, I'd say. I would say, Ralph, one thing that's still quite an interesting question for all of our listeners is you mentioned human in the loop. You sort of fall on that spectrum of full automation versus your trading team still being there on the let's keep the human side of the divide. Not everyone's there. Some of your competitors are algorithmicizing more radically. What do you think? What is your thinking behind this? And could you give us an example of like where it matters?
I will say that obviously, software and AI are incredibly important when it comes to ensuring the optimal results for BES. As we mentioned, they're highly dynamic assets that can change direction incredibly quickly, and can access, certainly in the UK, and a huge number of markets. So that can't be managed purely by a human. Just the number of data points, the number of decision points that need to be made has to be software driven and algorithmically led. However, you're right that I and Habitat absolutely believe that the human in the loop having a human in the loop is the best way of getting the best results for batteries. And that is really because, I say this all the time, and I apologize for anyone who has to hear me say it again, you can't train algorithms on conditions they've never seen before. And we do exist in an ever-changing market. So to ensure your asset is in the right market at the right time, and your algorithms and your dispatch are making the right decisions, you need human oversight to do that. Secondly, human oversight over asset conditions is incredibly important as well. We have an entire operations team who are constantly observing the state of health conditions of the asset, so its temperature, their communications, to make sure that the assets are behaving as expected within warranted and safe levels. Health and safety is fundamental to our approach, and making sure that assets are being managed and operated incredibly safely. And we know how important fire risk is to our clients as well. What I will say is, to scale as a business, we can't rely just on humans. So, our expectation is that as we move forwards, more and more of that decision making will be made by algorithms. And certainly as we get more and more market data and the market not necessarily stabilizes, but the variance in conditions isn't as prominent as we've seen maybe over the last 3 years, it's potential 80% of those decisions will be made by algorithms, but you need the humans to cover those tail events, not just in high volatility markets where because of the sort of price spreads you see, you want to be sense checking those decisions by the algos to make sure they're the right decisions. They might be, shock conditions like we saw with the Ukraine war, where you need, or black swan events, where you need humans to be making those decisions.
You mentioned increasingly relying on fundamental models rather than statistical ones. You can't train a statistical model on data it hasn't seen, but if a fundamental model reflects more fundamental relationships, then perhaps there is a further scope of reducing the need for humans. So it's a bit of a curveball, but it's a conversation I had with one of your competitors, and I'm very curious about your view, whether that's potentially a direction of travel.
I think it's a really interesting point. And as we mentioned earlier, part of the reason that we are putting more emphasis on fundamental forecasting, you can absolutely look at historic relationships that we've seen between fundamentals and price. So key drivers like wind generation, demand, gas price, all of this can help you, based on your fundamental forecast, assess where price will go, and then utilize that to make more automated decisions going forwards. And then, as we mentioned, supporting that with probabilistic forecasts as well, absolutely help you sense check those forecasts. And yes, my view is that to scale effectively, AI and software should drive the majority of the process because of the sheer complexity of battery assets, the markets they can play in, how quickly they can change directions. There are so many decision points that need to be made that you can't ask a human to do that themselves. So they are reliant on that machine learning, forecasting, and algorithmic mismatch approach, be it led by the fundamental forecasting or the probabilistic forecast element. There will be conditions where you will always need those humans, though. I think periods of very low volatility have been really interesting, tend to get actually overlooked, because in those periods of low volatility, your traders, or rather your trading strategy, actually needs to work harder to add what we would class as good value for a
like a hedge
trade.
fund, right? The original hedge funds were adding value when times were bad. They were hedging.
Yeah, exactly right. And I think that's where a good optimizer really shines, in those periods where you don't have the obvious opportunity to make money. How do you add additional value there? And that's where our traders are looking at novel trading strategies that they can deploy to help add value. And that's things like cross-market optimization. So looking at the different wholesale markets that you can trade across, re-optimizing your positions more regularly to add additional value. And ultimately, you may need to cycle your battery a little more in those periods to extract a little bit more value. And that's when that key decision point between, do I cycle more now to add value here, or do I reserve those cycles till later, where I think there might be higher spread opportunity? That is, a discussion that our team has internally, but it's also really dependent on the risk appetite and risk framework that we have with our clients as well. Because ultimately, these are our clients' assets, and they have a large say in the trading strategy that we deploy.
That's a great segue to my next couple of questions, which is to what extent your strategizing depends on the asset owner. But before I go into that, I actually wanted to ask you, how do you know you're good? So you've made a lot of decisions. You think you're good. There's certainly some market evidence in a sense that asset owners seem to trust you, but it's not a very transparent market. You don't know how much your competitors are making. How do you know you're good?
A very good question. And I sympathize with the market tremendously with the lack of transparency of data that exists in this space. Honestly, I would say I wish there was more transparency, because I think it would show Habitat in an even better light than we're held by a lot of our clients and the market as a whole. So that being said, public data, despite not being complete, is still a reasonable indicator of performance. So you can see, ballpark, certainly with assets in the UK within the balancing mechanism, how those assets are performing with some degree of certainty. And obviously there are things that are missing from that information, like wholesale market re-optimization in the intraday market, in the imbalance markets, if they are non-BM assets. But we can draw some conclusions from that. And so from a publicly available data point of view, habitat tend to perform very well. So that's our first sort of point of reference. Beyond that, we have one obvious telling point that we're doing a good job, which is our existing clients continue to give us more volume, especially when those clients already work with other optimizers. It's publicly available knowledge, so I can talk about it. The framework we signed with Gresham House for 500 megawatts of battery storage optimization in the coming years is a real vote of confidence from a client who've been working with for multiple years. And I think that is certainly one way we know we're doing a good job. And talking to those clients is a way we're knowing we're doing a good job, not just in terms of performance, but also in terms of client service. We find that open line of communication is incredibly important. We obviously do our own benchmarking internally as well. So we will look at our actuals on our projects and then run various simulations of other assets within the market based on digital twins or different trading strategies that we think we could have deployed with those assets to see what we think we would have earned with them. Mm-hmm. And that does help. We have some data about what those assets are doing, and we can utilize that to make some assessment. But you're right, the lack of transparency makes this market very difficult to compare like for like within.
Ralph, and an interesting aspect of it is what you mentioned, which is you will have owners who work with multiple trading optimizing partners. Why do you think it is? Is it purely a diversification strategy, the way you would put your money into multiple hedge funds to keep the analogy, or is there an element of specialization, which is I will give this type of asset to Habitat and another type of asset to someone else?
I think a combination of two. It is really client dependent, and I think different clients have different strategies, so it's difficult to tar the industry with one brush. That's not fair. It's difficult to generalize across the entire industry. However, yes, to one point, you can only compare truthfully optimizer performance if you have two optimizers within your own portfolio on similar assets. That is a way that you will absolutely be able to compare their capabilities. And so an element is diversification of, if you want to make sure you have good performance, you might choose two top tier optimizers to manage your portfolio. So if there is a slip in one, you would hope that the other will still perform well across the remainder of your portfolio. Mm-hmm. Mm-hmm. But there are different approaches by optimizers. There are optimizers like Habitat who focus on complex market optimization, cross-market optimization to really maximize value and have a real data forward, machine learning forward, and hybridized approach to get the best value for assets. There are some who don't adopt that level of complexity, but do provide other services that asset owners find appealing, like revenue tolls, or tolls for the asset, I should say, or appealing revenue floors. There's certainly within the market, depending on client, once again, risk appetite and value goals, a desire to have some form of contracted revenue on their projects. So having part of your portfolio with someone who may not maximize value and who you may have to give up some upside to get some revenue certainty from, but secures you a guaranteed IRR for your project, if you like. Mm-hmm. Having some of your portfolio with that structure, but then rather having the rest of your portfolio for a more revenue generating, sophisticated approach actually gives you diversity of strategy. And we've certainly seen that as an approach taken by some asset owners.
Mm-hmm, mm-hmm. So you have like your high risk bit, your equity bit, and then you have your floor, that underwrites some of your asset. Okay. What about owners who bring these capabilities in-house? I think, you have the Gresham houses who trust third-party providers like yourselves, but you also have some other very sophisticated players who develop these capabilities in-house. Is this a threat, you think? What would be your pitch to someone who's thinking of bringing it in-house to keep commissioning Habitat instead?
There's a very simple one, which is it's harder than you think. I think is the obvious one. But also there's a high cost to doing so. And I think the main driver that people should select someone like Habitat or a third-party optimizer is that the cost of setting up a trading desk alone is probably £2 to £3 million. And that's before you consider the software you need, the tools and experience you need to do so. From a cost-effective point of view, paying experts like Habitat to manage your portfolio for you and get the best results for you with certainty is, in my mind, a much better business strategy. I'd also say that interestingly in this market, because even the UK market, which is mature, it's still a relatively nascent market, and there is a bit of a human capital shortage in this space. There's a limit of trained, knowledgeable experts in both trading assets, integrating with assets, data science revolved around the forecasting of these markets. It can be difficult to find the right people to source a team internally. So once again, if someone has those capabilities already, it would make sense to utilize them.
Makes sense. And you keep mentioning that your approach is quite tailored to who you work with. How much tailoring is there in practice? Specifically, do asset owners ever exert some pressure on you in terms of trading strategy, choose markets in which you should and shouldn't play? And if so, does it ever turn into a blame game? It's like, you didn't make enough money. Well, you told me not to play here.
I would say it's a very collaborative, process with our clients. Ultimately, at the outset of our relationship with any client, that conversation will be had as to what their goals and objectives are, and we will look to build a structure, a trading structure, a risk framework structure around that before the asset even goes live. So everyone is on hopefully the same page before we start trading the battery. Yes, and risk appetite does play a key role in clients deciding, or rather Habitat deciding how we'll trade the assets. I think it was interesting when we had significantly more value in, say, the ancillary service market, in a relatively low cycling market or relatively low cycling requirement services, but with good value. Some asset owners are probably more happy with us, going into a slightly less complex strategy and capturing that value. However, there is always additional upside and other opportunities. And so looking at the merchant market and bringing those opportunities to clients, explaining them to them and getting them comfortable with that the risk associated with those strategies fits within their remit, or can they get comfortable with that risk, is really important for us. We have these conversations with asset owners initially on a day-by-day basis when assets go live, but then weekly cadence, monthly cadence. So we're constantly talking about how that strategy should change. I think the interesting thing is there will always be days where you don't capture 100% of the market value. I mean, no one has perfect foresight in this space. There will be days where you miss out. I think it's really important to note that for batteries, this is a statistical game more than anything else. There are so many different trading decisions you're making over such a long period of time. The lifetime of these assets before your first repowering should be 10 to 12 years. So if you miss a day's value, it's not great, but ultimately there will be more opportunity going forwards. And people should really consider it almost as a statistical game, that it's about getting the majority of those decisions right as you move forwards.
So speaking of risks and sort of tailoring your approach to one's risk appetite, we've seen the market evolving from a much simpler business model of playing in some of these ancillary service markets with stable longer term contracts to a lot more merchant operation. And I think perhaps where the edge of that risk appetite is probably in non-physical trading, where you can assume pretty much any level of risk with potentially, well, not quite unlimited, but almost unlimited gains, depending on how you think about it. How do your clients tend to think about it? And sort of what do you think are the key reasons why one might or might not want to assume that type of strategy?
Sure. Complex question, but a really important one, I think, especially as we're moving to a more merchant-driven market in the UK, especially. At Habitat, we absolutely see non-physical trading as a vital component of re-optimization for your assets, and absolutely necessary to maximizing battery revenue in the UK. I think how you define non-physical trading is pretty important. So when we talk about non-physical trading, we mean essentially where you've taken positions in the market where you haven't had to deliver power physically from the asset, but have captured value. Tends to be where you take equal and opposite positions in different markets to essentially neutralize your buy and your sell, or your charge and your discharge, not have to cycle or dispatch your battery, but capture the spread between those markets. So that is a really core component of getting the best value for your battery. What I will say is there is a difference between trading what an asset is capable of delivering physically versus what could be considered more speculative trading. So you can look at, in its simplest form, having a dispatch profile that the asset could deliver based on its state and charge and its warranted criteria, but then just re-optimizing that opportunity, cycling at different times and neutralizing positions to add value. That is probably a more asset-backed approach and comes with significantly less risk. And it's probably one that's favored by clients because you're less likely of the market moving against you. You're less likely to take significant risk exposure through it. Obviously, the key challenge is how the price develops versus your forecast value, and does the spread that you've captured material, or spread that you've planned to capture.
Wild prop trading speculation is not yet in problem.
Well, but could very much be the future of this space. I think, that there's an argument that you don't need an asset to focus on that type of trading. It is essentially just speculative prop trading. But ultimately, I think it's a really interesting option for battery owners who might look to take on more risk to increase value. The challenges you face are the credit requirements to following that sort of trading strategy are higher. Also, if it's non-physically backed, you are at exposure for non-delivery risk, and also, more exposure, the more trades or more churn you're looking at of the market moving against you. So it does come with higher risk associated to it, but with higher risk also comes higher reward. So there, I think, considering where we've been over the last 2 months in the battery space, where some of the winter value we would expect to materialize hasn't, asset owners are starting to think more creatively about strategies, and certainly trading teams as well at Habitat are starting to think about where we can add value for clients looking forwards.
Rolf, we spoke about many optimizers in this market. I wanted to come back to this for a second, because what I think is on many people's minds is to what extent this market is ripe for some form of consolidation, especially after a period of, like you said, lower volatility, lower returns. We have many optimizers, we have also many owners. Do you think there's consolidation on both fronts coming behind the corner, or where do you see this?
I do expect some consolidation. I think we've already seen some of it, to be fair. We've seen smaller optimizing companies being acquired by larger parties. Linejump being acquired by Shell, Open Energy being acquired by BP. I guess Equinor picking up Danske and Norica. So, or at least a large share of Norica, I should say. So there was already consolidation there between possibly 6 or 7 parties who could have optimized, now down to 3. So on an optimization front, we've already seen it. I think there's some really interesting prospects ahead of possible consolidation on asset ownership. The connection reforms that National Grid have brought in, especially around the tech register and are very welcome, obviously, in this space, and really exciting. But they've now put on these specific milestones that developers have to reach or prove that they've hit. Otherwise, they'll lose their place in the connection queue. Some of those considering the scale of these projects, some of those developers may not have the capabilities or the capital to make those milestones, and will no doubt be looking for partners or even potentially selling those assets to ensure that they can get some value for them without them slipping way down that queue. So I think there's likely to be a consolidation of some of those larger transmission connected assets. I think also what's been really interesting over the last 2 years is because we've had this period of, I'll call it supernormal battery profits. It's probably not entirely fair, but because we've had a few years of very high battery profits across all development projects, I think the premiums that assets have been acquired for have been rising quite substantially. I mean, in some cases, quadrupled since when I started at Habitat. And that does put pressure on projects when you see the normalization of revenues that's occurred. And once again, I think we may see similar consolidation with some of those projects that may not have the same IRR forecast that people expected them to when they first acquired them, because of some of the change in the forecast outlook of revenues. That means that those assets may end up with players who've maybe got a slightly more longer term view, and once again, the capabilities to build out and get the best value for those assets.
Rolf, so we touched a little bit about on the market changes that you've seen over the last few years, and a lot has changed. The non-physical trading, more merchant operations. One other important aspect is the emergence of floors, and you already touched on this. How do you see this developing, and to what extent this is an important part of an optimiser's role to be able to provide a floor like this?
Yeah, really good question. Floors have been around since I started at Habitat, but with very different purposes, or rather, I would say asset owners taking them for different purposes. I would say historically, floor was appealing for asset owners who had low risk appetite and were looking to secure a specific IRR and weren't so concerned about giving up some of the battery upside to secure that. But as we've progressed, we've seen more and more providers looking to offer floors in this space. I think it's fair to say almost every optimizer can offer a floor either from their own balance sheet or via a partner now, Habitat included, which is exciting. But the requirement or the reason for them has definitely, or the reason for their popularity is definitely changing. I think as we've moved forwards, we're really seeing the scale of asset in the UK market change. Once again, when I started in this space, the largest assets you tended to see were 50 megawatts. But now we're talking about enormous projects at the 500 megawatt stage, actually up to gigawatts. I mean, some of the projects that have come across my desk recently are over a gigawatt in terms of size. It is very difficult to fund assets of that scale off balance sheet and off equity. So we're seeing parties look to bring more debt into those projects and go out to the lending space, large financial backers and banks looking to bring debt in from those players for those assets. Understandably, anyone who's lending that amount of money to projects want to ensure that the debt that they have given you is paid back. And one way of doing that is securing contracted revenue or downside revenue protection, we should call it, via either a floor or a toll. I think that's really bolstered the popularity or need for floors within optimization agreements and has made it a fundamental part of any optimizer's offering.
So it's partly out of, or largely out of necessity. So if you're a fund and you're a big enough fund and you can afford not to take a floor and you have an optimistic view on the volatility and the fundamental case for battery, you probably wouldn't do it still, right? It's
yeah, absolutely. And I think you look at some of the very knowledgeable and experienced funds in this space who own significant numbers of batteries. A lot of their portfolios don't have floors and actually don't have that much debt financing within them either. But these enormous projects and some of the new players coming to the space who aren't as familiar with the market do want that certainty.
Anything else that changes to you as an optimizer with the emergence of these mega assets?
A little bit. I think, interestingly, as we move to more transmission connected assets, the roles and responsibilities of an optimizer certainly change and increase. You find yourselves having to have the necessary EDL and EDT communications capabilities, as well as control telephony. You have to act as a control point for these assets. That is a layer of responsibility that some optimizers can't provide or can't live up to. Habitat have been optimizing transmission connected assets, or a transmission connected asset, I should say, since 2020. So it's something we're very aware of. But also with transmission connected assets, optimizers now need to be very mindful of their obligations under the transmission connection license conditions. So there is a significantly larger degree of responsibility that sits with these optimizers now. I think what we're also seeing that's interesting is larger assets being considered to be broken down into smaller BMUs. So same site, but different units. And that opens some really interesting trading strategy opportunities. So being able to put the same asset into different markets, possibly looking at different cycling strategies across those BMUs. In some situations, actually having separate optimizers on the same asset. So there are some really interesting changes to the market that are occurring with these larger assets.
Yeah, I suspect the one is saturation, right? If you bid a 1 gig asset into some of these smaller markets, you can saturate it pretty much on your own.
Yeah, absolutely. Now, there are thresholds to certainly the ancillary service market as to how much you can bid in with one unit. So that does help at least. But you're absolutely right. When you've got a threshold of just over a gigawatt for some of the ancillary services, one asset could absorb all of that if it was broken down to multiple units in theory. Interesting stuff, I think, and a really exciting time for the industry in general.
Speaking of interesting times, one thing that I think the industry is especially excited about in the UK are the changes to the balancing market. So obviously, historically, we've had issues with batteries not being accepted in the balancing market, despite being in the merit order. We've had that addressed with the open balancing platform. Has it been a success so far, Ralph, in your view? And where do you think this is going?
Good question. The dust is still settling to some extent on the open balancing platform, but I think we're broadly positive about the changes that it's thinking to bring in. We've certainly seen an increase in activations of batteries within the BM. I think it's debatable whether skip rates have changed significantly for batteries, which is obviously the biggest concern. Batteries aren't taken based on their price in merit order within the space. The challenge has always been, and the goals of National Grid are, absolutely the right ones, to try and get more batteries into the balancing mechanism. That helps, actually, to our earlier point with regards to data transparency. But from National Grid's point of view, understanding more and having better warning of what batteries are looking to do and being able to manage the system more effectively and utilize those batteries more effectively to manage system stability. So ultimately, it's a really good idea. But I think time will tell over the next few months how successful it is. It's still arguable whether it's increased value for batteries within the balancing mechanism. I've seen some analysis that suggests the value has increased slightly, sort of a 10 to 12% uplift potentially in the BM, which is a start, I think, in this role. Ultimately, we've viewed the balancing mechanism as the natural home for batteries for a long time at Habitat, or at least one of the key revenue streams for batteries. So I think anything that encourages them to be used more effectively and correctly in that space is a good thing.
Sounds like still beginning of the road, but at least we're on it finally. Ralph, we went deep into the UK specific, one might say, parochial issues. Let's zoom out and think globally. You've entered multiple markets and looking at a few more. Could you tell us a little bit more about the markets you have entered and how did you choose them and how you compare them?
Yeah, sure. And I realize we've really skirted over this up until now. So as I mentioned, Habitat active in the UK, Australia and Texas in the US. The choice of those markets was a relatively easy one for us. They're the fastest growing markets, or at the time were definitely the fastest growing markets in terms of megawatts of storage being built, but also where Habitat's sophisticated approach would add the most value, where there are multiple revenue streams and multiple markets that assets can be optimized across. So from our point of view, they were natural fits for us as such. I think also interesting the granularity that are traded at and the complexity that exists there. We thrive on complexity. So actually, when you're looking at a market like Australia that trades at 5-minute granularity rather than 30-minute granularity, that's another layer of complexity in your optimization, which we feel our software and approach is really well suited for. They do compare differently, however, which is interesting. In Texas, I mean, that market is going to be huge. It's going to far outstrip the level of storage we have in the UK. Annoyingly, I suspect my US team will start to crow quite soon about how much more megawatts they have signed in that space than I do in the UK.
Familiar problem with Aurora.
But interesting when you look at Australia, which actually has a similar scale capability, there's far more hybridization of sites there. And that's to do with how that network is built or how their transmission and distribution network is constructed. There are very different ways in how those markets are traded as well, but all of them have really important learnings that I suspect will at some point be transferable across them. You have the Texas market being traded nodally, which was at some point a consideration for REMA in the UK, which had it happened, I would say if it does happen, I think Habitat will be well suited to trade with them because of the experience we're getting in Texas. The Australia market is slightly more zonal, not necessarily quite nodal, but zonal, and the UK market is a national market currently. So there are differences between them there. Also, how they're dispatched. The UK market is self-dispatched. So optimizers and asset owners have control of how those assets are dispatched. Whereas in Australia and Texas, you have centralized dispatch, where the system operator is dictating how your assets are going to be used in those spaces. That leads to differing optimization logics. The UK is still the most mature and has the largest number of markets that batteries can be traded in. And certainly when it comes to wholesale operations, still the most complex and adds certainly the most re-optimization value. You don't have an intraday market in Texas, and you don't actually really have a forward market in Australia, but both have real-time and day-ahead markets. So there's opportunities there.
Specifically, the nodal aspect of the markets, does that make a huge difference from you as an optimizer perspective?
It certainly requires better forecasting and better understanding of the system and how the system is dispatched. Because in those situations where you have nodal markets, you can have significant constraints and liquidity issues in those specific nodes that can lead to really high value opportunities for batteries. So you need to be aware of the dynamics there and when those really high value opportunities are going to materialize. It's much more complex, though, to understand the interlinking of the system and how the nodal price will vary based on other drivers across that system. I would argue to some extent the UK is a lot more easy to predict in that respect, bar a little bit of locational constraint management that you need to be mindful of.
Final question on this international aspect. Do you see the same competitive landscape in each market? Do you think it's going to be a global market with the same few optimizers winning globally, or is this more localized?
I think it definitely varies by market. In the UK, we really see value put on the holistic approach that Habitat has, so algorithmically dispatch with traders. Whereas actually, interestingly, in some of the other markets, especially Australia, we see more of a preference towards a software-driven or purely software option in those spaces. And that's a very different competitive landscape for Habitat, and it completely changes our offering in that space to some extent. UK markets are definitely more crowded, as we've discussed at the top. I would certainly say there are fewer optimizers in those other markets. Interestingly, in Australia, there are more entities with their own trading team who are quite eager to manage that process themselves and actually just value the intelligence that Habitat brings rather than necessarily some of the capabilities we bring. So I think they are very different spaces. Also, the asset owner space is different. We're only really starting to see over this year multiple jurisdictions being explored by single asset owners. So starting to see some counterparties look to leverage their success in the UK by building assets out in other locations. And I think that's quite interesting too. So hopefully we'll start to see some of those successful players really build out great assets in those locations. And hopefully Habitat will get to optimize them.
Next market getting hot?
Oh, that's a great question. Yeah, as you rightly said, we've got eyes on different markets. Obviously, the US and Australia are ever growing and very exciting. I think there's been really interesting developments in Germany. Germany has been a very sophisticated market when it's come to smaller scale, behind the meter co-location of storage or actually just residential storage and aggregation of that. But now seeing development of utility scale really grow in that area, which is exciting. And I think it's becoming a little easier for outside participants to potentially enter. But partnerships will be key there. Japan as well, similar environment, some of which is now getting really comfortable with the idea of other optimizers coming into the space, really looking to build out batteries. A very, very interesting market. And Italy and Iberia, on a co-location front, I also think are looking like very interesting markets. The sort of scale of development of renewables, which will have batteries co-located with them in both locations, make them very, very interesting markets to focus on. The other one that I would point on my radar is probably Poland, whose recent capacity market showed significant capacity of battery storage being taken. And that, once again, makes it a very interesting opportunity and with very interesting system price opportunities as well.
Well, you basically covered our Kronos roadmap now. So I'm glad we align with regards to what's hot, what's not. I'm going to wrap up with just one question. What are you most excited about at the moment, other than all these markets we've just discussed?
Yeah, I'm quite boring compared to some of our teams. So I'll tell you what I'm excited about and maybe what Habitat's excited about. I think for the first time in ages, we are actually in a market, especially in the UK, that's really driven by merchant trading rather than ancillary services. So seeing the novel strategies that will need to be deployed and how participants perform in these conditions is really exciting. I think it's just a really good period of exploration and new development. Also looking at some of the new services that are going to be deployed in the coming year or so. Quick reserve is on the horizon, which may offer a really interesting opportunity for battery storage going forward. So looking at what that service may constitute, volume requirements from National Grid, and the potential value opportunity there is really exciting in this space. Interestingly, the long duration energy storage consultation that's ongoing at the moment as well has some very interesting implications for this space. So that's ongoing.
A fair amount of controversy.
Yeah, hugely so. I think this cap and floor mechanism, and also, something that's been talked about a lot in the industry has been the financing gap to making long duration energy storage viable in this market. So trying to find a suitable mechanism to do that, and what that mechanism might mean for the rest of the market is really interesting, and something I'm looking to be very focused on going forward. We've talked about the scale of some of the assets coming on, the fact that we're seeing more 2-hour, even longer duration battery energy storage assets being deployed in the UK. Once again, different class of asset, different ways of trading. Should be really interesting to keep an eye on. And co-location is starting to pick up in the UK after what felt like a bit of a hiatus. And I think that is a really interesting growth area for this market, and something I'm very excited about focusing on, finding the absolute optimal way of trading those assets, the right contracting structures as well as the right optimization approach. It's going to be a really exciting adventure, especially with some of the recent CFD outturns.
Yeah, I think co-location will be a separate podcast on its own. There's definitely enough there to cover. Ralph, thanks so much for sharing your insights. It's been incredibly useful. I've learned a lot. I'm sure our listeners will have too. And thank you to all of you who will have listened to it. Cheers.
No problem, Mateusz. It's been a pleasure. Thanks very much for your time.
That was Mateusz Wronski, Global Software Solutions Director for Aurora, talking to Ralph Johnson, Head of UK Business Development for Habitat Energy. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.